Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Did Japan just threaten economic war with America? While rumors swirl of a U.S.-China trade deal last week, Japan went rogue, with Japan's finance minister Kato threatening to use Japan's $1.1 trillion stockpile of U.S. treasuries to crash our financial system, which could set off a financial crisis on the order of 2008. The Financial Times called it a, quote, baring of teeth. One Japanese analyst called it a dangerous provocation. Dangerous because if Japan were to dump hundreds of billions in treasuries, it could crash the entire American financial system, sending interest rates soaring and bond prices crashing. This would raise interest on mortgages and business loans, hitting home prices and strangling business, would also raise interest on our $37 trillion debt, but most important, it would bankrupt American banks whose assets are overwhelmingly in U.S. treasuries. As in, if bond prices collapse, their assets are worth less than what they owe depositors. They are bankrupt. We got a taste of this in 2023 when a parade of banks failed as bond prices fell on Fed hikes. Now, Kato later clarified that Japan has no plans to sell at the moment, but the message was loud and clear. Japan is perfectly happy to stab America in the gut. In case you wonder how much goodwill 80 years of protecting Japan bought us, turns out they see it as a protection racket. We pay or else. In a recent video, I mentioned how dumping treasuries is the nuclear option for China, who actually holds less than Japan. China only has $800 billion. I didn't figure China would go there since Trump has some nuclear options of his own, including cutting off Chinese companies from U.S. capital markets. I did not expect Japan would be the one to go there. After all, Japan needs us a lot more than we need them, so they buy just half what they export to us, and most of what they buy is energy, not manufacturing, so it doesn't create that many American jobs. Most important, Japan receives north of $70 billion a year in free protection from the U.S. military, plus a nuclear umbrella and 50,000 U.S. Marines worth of tripwire, all free of charge. So Japan gets to run a $63 billion trade surplus, and it pockets $70 billion free from American taxpayers, Uncle Sugar in living color. And if we stop, apparently they will crash our entire financial system. So what's next? Throughout this trade war, it's been downright striking how our supposed allies, like Canada, Europe, and now Japan, are apparently perfectly happy to turn on America as soon as the handouts stop. This should not be surprising. After all, countries are not charities. They don't have friends. They have interests. Only in America is it our sacred duty to spend hundreds of billions for other countries and get shafted in return, to the point anybody who speaks of allies is probably picking your pocket. As for Japan, so long as we're baring teeth, it's an excellent opportunity for Trump to casually mention how the Japan-U.S. Security Treaty simply requires the U.S. to, quote, act if Japan is attacked. As in, no military response is required, no 50,000 Marines, just a sternly worded letter when China starts taking the Japanese islands they already claim as Chinese territory. When China is sitting down to talk and our supposed allies are making threats, it calls into question why we keep it up. The U.S.-China trade war is over. Well, it's resting for 90 days. Markets are jumping, gold is sliding, bond markets are climbing off the ledge as Treasury Secretary Bessent announces a pause to the trade war with China. In fact, stock markets have now recovered all their losses since the trade war, with the Dow gaining 1,000 points on the 90-day pause. By the way, gold is still up $100, 3% since Liberation Day. Bitcoin is up 20%, so everybody made money. Analysts are downright giddy, dancing that the recession is over. So the U.S. and China announced we will reduce tariffs on most Chinese goods from 145% to just 30%. China will reduce its tariffs from 125% to 10%. It's just a 90-day pause, the idea being to work out a longer-term trade deal. That might look a lot like what Trump negotiated in his first term back in 2020, which had China buying an additional $200 billion over 2 years, along with reforms to China's non-tariff barriers and intellectual property thievery. Specifically, China committed to removing effective bans on U.S. agricultural products as back in 2020, so beef, poultry, dairy, as well as allowing U.S. banks access to China. It also promised to prosecute patent theft and counterfeiting, and to stop so-called forced tech transfer, where Beijing makes you give your tech to Chinese partners, effectively training your competitors. So all that looks very good on paper, but of course China failed spectacularly to hold up the agreement last time. It only bought about half what it promised. It made very little progress on the barriers, thievery, and forced tech transfers. Now, there was a built-in dispute mechanism to impose new tariffs, but at that point, America was in the clutches of Joe Biden, who did nothing about it. Trump's been vocal about all this, the failure and the lack of consequences, so presumably he will want a deal with more teeth. So what's next? Trump had two goals in this trade war: to use America's massive market as leverage to negotiate better trade deals, and to start bringing manufacturing back to re-industrialize America. Just over a month, he's already got deals with the United Kingdom, India, and possibly China now, with Europe, Japan, Canada, and Mexico on deck. But more important, reindustrialization is actually working, with north of $5 trillion flooding into America to build factories inside Trump's big, beautiful tariff wall. In other words, a month of legacy media hyperventilating about the end of the world, and we got better trade deals, crazy investment numbers, and a Dow Jones that is up. The ball now passes to Congress for next year's tax and spending bills. These matter because reindustrialization needs reasonable taxes and it needs reasonable limits to red tape. I mentioned in previous videos how regulations in manufacturing cost more than the salaries in America, so more than $50,000 per employee per year in regulatory costs, most of which is environmental and diversity mandates. Trump can deprioritize those mandates, but outside tariff avoidance, he won't get that American renaissance in manufacturing until Congress actually gets rid of them. Happily, this is all very easy. Just fire 30,000 regulators at EPA, OSHA, and the entire Washington alphabet soup. Let the D.C. Beltway get the Rust Belt while the rest of America takes off. A word from our lead sponsor, Unchained.com. It's time to think about your annual IRA contributions. An IRA is an investment vehicle that can save you a lot of taxes. With Unchained, you can hold real Bitcoin in your IRA, get access to trading, inheritance, and loans, and it's the only company where you hold the keys and can verify that your Bitcoin is not being relent like banks do. We've seen futures-based ETFs underperform holding your own Bitcoin, so why settle for less? Book a friendly consultation at unchained.com/Peter. If you own gold or silver, you know they're a great hedge against financial instability and let you grow your wealth outside the banking system and gain greater control over your finances. Monetary Metals offers you the ability to increase your precious metal ounces every single month. Instead of paying to own metal, with Monetary Metals, you get paid 4% on your gold paid in more ounces. Now's the time to secure your wealth and build your legacy in an asset that the government cannot inflate away. Join thousands of investors earning interest in physical gold and silver every month with Monetary Metals. Visit monetarymetals.com/Peter to learn more. Now back to our show. Donald Trump just slashed U.S. pharmaceutical prices. Are the days of $100 insulin over? Last Sunday, Trump issued an executive order mandating most favored nation pricing for pharmaceuticals, as in drug companies can charge no more in America than they charge in the cheapest rich country. This would imply a reduction in price between half and 10 times. Now, the order targets Medicare spending, which is about a third of U.S. drug spending. If he extends it to other government programs like Medicaid, it goes to roughly half. But Trump introduced the move with a story about his, quote, highly neurotic, overweight friend, presumably Elon Musk, phoning from London how his, quote, fat shot cost $1,300 in the States, but just $88 in London. Trump noted correctly that American patients are effectively subsidizing socialist healthcare systems all over the world, as in Pharma makes all their profits in the U.S., and then they sell to Canadians, Europeans, and Japanese pretty much at cost. To give a flavor, diabetes drug Jardiance is $70 a month in Switzerland, it's $35 in Japan, and it's $611 a month in the U.S. for the same drug from the same factory. In fact, the U.S. makes up roughly 5% of world population but generates 2/3 of sales on big drugs and essentially all pharmaceutical profits. It's even happening without socialized medicine. Canada, for example, does not cover pharmaceuticals, so most Canadians pay for private insurance, and about 1 in 5 Canadians is uninsured for drugs, just like the U.S., and yet insulin in the U.S. costs $99 per vial and just $12 in Canada. So why does this happen? Because almost every country in the world negotiates with drug companies to force low prices as a condition to sell any drugs in their country. Canada, for example, strong-arms drug prices, and if drug companies don't play ball, Canadians will simply get all drugs that are cheap. In the U.S., in contrast, Pharma charges what it likes, fortified by billions of lobbyist money and billions more in advertising that talks Americans into 4.8 billion prescriptions per year. Now, Pharma claims most favored nation pricing could cost them $100 billion a year. In other words, they're admitting they overcharge Americans $100 billion a year. The bigger issue is Pharma claims this would gut R&D, as in if they don't charge Americans 30 times more, no new drugs would exist. Of course, there's plenty of R&D in other industries, from electric cars to semiconductors to smartphones, without charging Americans 30 times more for an iPhone. So the most likely consequence is American prices drop by half or more, while foreign prices soar to the point Swiss bankers no longer get single moms in Michigan to pay for their pills. So as an expert, for years now, Pharma and healthcare in general has been at permanent war with Donald Trump for trying to reduce costs. In his first term, Trump proposed importing drugs from Canada, widening access to generics, allowing pharmacists to recommend cheaper alternatives, which was amazingly illegal, and price transparency so hospitals tell you the cost up front. Most favored nation beats all of those combined, and it could finally end one of the many ways the rest of the world freeloads on Americans. Inflation just hit a 4-year low, so much for that tariff hyperinflation. Gas is down, groceries are down, eggs dropped 13%, the second biggest drop on record. This all took wages to their fastest growth since March of 2021, the very beginning of Joe Biden's reign of error. Even CNN admitted the good news, saying, quote, "It's an unexpected development that's defying economists' expectations. Maybe they need better economists." Regime mouthpiece NBC News responded by launching a new food price tracker, which is fun because inflation almost always rises thanks to the Fed, so they're hoping to ding Trump when they never ran a tracker during Joe Biden's 9% inflation. The new numbers take Trump's annualized inflation to just 1.6% in his first 3 months. That's about half Joe Biden's last 18 months, is about 1/4 Biden's final annualized number on inflation. In fact, ironically, 1.6 is exactly the same number inflation was when Trump left office last time, defying economists' expectations. Breaking it down, over half the inflation that we did see was from shelter, where the Bureau of Labor Statistics uses a weird lagged shadow number that means most of it is actually left over from Joe Biden. There was literally zero inflation in goods. Those were supposed to soar on tariffs, which came at the beginning of the month. For the specific things most hit by tariffs, China-heavy household furnishings were up 1%, but clothing was actually down. New cars were also flat. They're mostly made in Canada and Mexico. So we got 145% tariffs, and that came to between 1% and nothing. Happily, used car prices were down a half point. That's annualized 6%, which I'm hoping is self-deportations flooding the used car market. The big one was groceries, down almost a 0.5% on the month. That's 5% annualized, led by plunging egg prices because Donald Trump stopped killing chickens, but also drops in fruits and veggies, bakeries and dairy, pretty much everything but booze. The Tame report gave color to the ongoing battle between Donald Trump and Jerome Powell over interest rates, which the Fed jacked up to fix Bidenflation that apparently Donald Trump just fixed. Last week, Charles Payne noted how China's central bank is moving heaven and earth in the tariff war. So they're cutting rates, dumping money, buying assets, whilst Jerome Powell sits back and does nothing. For 3 months now, Trump has delivered inflation numbers that are below the Fed's target, meaning normally they'd be looking at interest rate cuts. Meanwhile, for 112 years, the Fed cuts obediently whenever policy needs it, whether for war, stock market crashes, or COVID lockdowns, but not tariffs that Jerome Powell admitted would be at most a point or two one-time hit to prices. Former Fed member Kevin Warsh, Trump's likely replacement for Powell, has been very vocal about this, saying if the Fed cannot handle a couple points one time, it sends a message to markets that the Fed is impotent. More likely, of course, Jerome just doesn't like Trump personally, probably doesn't like tariffs, and is trying to usurp the democratically elected president to run the country as an unelected Wall Street bureaucrat. So what's next? 3 months in, Trump's ended Bidenflation, even with tariffs that were supposed to do the hyperinflation. He's growing wages. They've already made back a quarter of the ground lost under Biden, and he's brought a historic avalanche of foreign investment to get inside that big, beautiful tariff umbrella, all with zero help from the Fed. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. Why don't Americans save money anymore? During the tariff war, a big reason stocks dropped was foreigners selling. Given they own over $60 trillion of U.S. assets, they were the tail wagging the dog. When foreigners got nervous, American markets plunged. Now, part of this is terrible trade deals, but a big chunk is Americans do not save money anymore. According to the Bureau of Economic Analysis, Americans currently save just 0.6% of gross national income. In the 1990s, it was 7.5%. In the 1960s, it was 12.5%. So what happened? Mainstream media focuses on consumer culture, so immediate gratification, advertising, credit cards. In other words, we are the problem. But of course, we had all this in the 1990s and even in the 1960s. So the 90s were the me decade. The 1969 Summer of Love is the definition of immediate gratification. Advertisements in the 60s were on everything. And by 1969, over half of Americans had a credit card. By the 1990s, they were as ubiquitous as today. Reality, we can trace the low savings rate to three things: stagnant wages, generous welfare, and above all, artificially manipulated interest rates by the Federal Reserve. So the wages and welfare combination actually has a name, the poverty trap, as in the more generous welfare gets, the less people work. They may as well kick back on the couch. In fact, if you work, you lose the benefits, so you are stuck. Now, when illegals push back-breaking jobs to minimum wage, all the more reason to sit back. Recent videos I've talked how wages stagnated for the young and blue collar starting in the 2000s, to the point they are the first generation in 250 years who do not out-earn their parents. Now, part of this is mass migration competing for jobs, dragging wages down to third world. Part is trade deals that opened our markets, but didn't open theirs. And part is the relentless march of regulations that wiped out small businesses, as well as the relentless march of benefits that buy votes by being people not to work. Put them together, and the net worth for the bottom half of Americans has been stagnant since 1989. There has been zero growth. While the poverty trap went to work on the poor and young, the middle class, meanwhile, got run through the interest rate wood chipper by the Federal Reserve. So between the 1950s and 2000, the average Fed funds rate was 5.8%. It's the interest rate. Since 2000, it's 1.9%, so 3 times lower. Adjusted for inflation, it's actually been negative since 2000. In other words, banks were paid to borrow money. This did 3 things. It gutted the return on savings, so for most of the period since 2000, banks have paid fractions of a percent on deposits. After all, why pay you when they're getting it free from the Fed? Second, of course, low rates drive inflation, most spectacularly under Joe Biden. This turned those fractions of a percent negative, so you're actually losing money by saving it. Third, low rates did a number on income inequality, driving up the price of assets from stocks to housing. that slammed the door on the biggest traditional savings pool, your house, your home equity. This rained trillions upon boomers, trillions they never earned, and it destroyed the young who are currently doom spending their way to debt slavery. So what's next? It'll take three things to get Americans back to saving: jobs that pay more than welfare, interest rates that reward savings, and controlling federal spending so the Fed doesn't need to force rates down. Now, Trump's doing his best. At this point, Congress needs to get off its butt. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.